Good morning, students. Today we'll be discussing about international accounting standards. Last class we have come across accounting standards, that is IFRS standards. We have discussed around 16 IFRS standards. So after discussing about those 15 IFRS standards, I have been telling you that all these standards are a copy of the previous standards which are available. So what is that previous standards which are available is, that is from the International Accounting Standards Board or the International Accounting Standards Committee. There are a few standards. I can tell you that at the international level, the international accounting standards play a vital role in the preparation of the financial statements. These international accounting standards, I mean to say that these international financial accounting standards, what we have, they play a vital role, as I already told you, and along with that, I can also say you that we are in the transformation, or we are at the process of changing the old financial reporting standards into new financial reporting standards. I can tell you that the old financial reporting standards at the international level are called as IAS, that is International Accounting Standards, and the new financial reporting standards at the international level are called as IFRS, that is International Financial Reporting Standards. Last class I have explained you about the International Financial Reporting Standards, that is the new standards. Not all the old standards are converted to the new standards. They are not rewritten. Only few standards are rewritten, and that we are calling them as IFRS. And still there are standards which are not rewritten. That is from the IAS standards to IFRS standards. Still there are various standards to be rewritten. So those standards now we are going to discuss. Now these IAS standards, they remain in their old form itself. The new form of standards is not yet been developed. So I can tell you that in the short process, very shortly doesn't mean 1 or 2 years. It takes 5 to 6 years of time for transforming these statements, I mean these financial reporting standards to IFRS. So now we'll come with the old accounting standards, that is the international accounting standards. We have around 25 standards which are still in the old format itself. We will discuss each standard, each one of those standards now, so that you'll be able to know what is the need for the old accounting standards, what is the need to understand the old accounting standards. So the first one is presentation of the financial statements, that is IAS 1. IAS 1 speaks about how do you present the statements. Statements here is the financial statements, that is the balance sheet, that is the profit and loss account, or the cash flow statement, or any other such statement. How are we going to present that? Now if it is within India, company is within India, you need to follow Indian standards. But when your company is a foreign company and you have entered into different countries, so you need to report that. So when you need to report that, how are we going to report? And what financial statements are we supposed to? What are the financial statements are we supposed to prepare? So here they have given like a statement of financial position as at the end of the period, a statement of profit and loss, changes in equity, cash flow statements. So these are the common statements which we are going to prepare every year. So now when you say that for the presentation of financial statements, there is a separate set or a separate format for the preparation of the financial statements that you have discussed in the IFRS subject, that is into the 5th semester IFRS. You have come across preparation of a financial, the statement of financial position. You come across preparation of comprehensive income statement. You also come across preparation of changes in equity. You also come across preparation of changes in cash. So that the same thing here we are going to consider. And the next is, the second standard is IAS 2. IAS 2 is a standard which speaks about the inventory. Inventory here means stock. Now when I say that stock is available within a company, And how is the company supposed to record the stock? Now, when I say the stock should be recorded by the company based on the cost basis or on the whether it is on the cost basis or on the basis of uh, market value or on the basis of cost of conversion. So what is that we are going to consider? So here mainly what we consider is inventories does not, inventory means opening stock, closing stock, and also raw material which is available, the opening stock of raw material, the closing stock of raw material, and also we have another part, that is the work in progress, the material which is in work in progress. So here I mean to say that inventories doesn't mean only the finished stock. It also means raw materials as well as the materials which is still in the process of conversion. So when the materials is still in the process of conversion, we can say that there is lots of material which is being kept in the process of conversion, and for each kind of stock you use a different method of valuation. Now when I say it is a finished stock, what is the method of valuation you do consider? So for finished stock we take raw material cost plus cost of conversion plus cost of conversion and any other expenses which is incurred. For raw material, only the cost of raw material and the transportation cost, storage cost, this is being taken. So, and again you have a stock of work in progress. The work in progress is not completely done, or part of the goods might be completed with 50% of work in progress, and another part of the goods might be with 80% of work in progress. So like this, now when you have different kind of raw materials or the stock, different kinds of inventories, we do generally have to consider what is the method we have to follow for all these three methods, for all these three kind of stocks. That is inventory, that is inventories. Next is IAS 7, which speaks about the cash flow statement. So what is this cash flow statement? Cash flow statement speaks about the total value of cash inflow into the company and outflows, into the company and outflows. And also your cash flow statement speaks about the three kind of cash activities. What is the three kind of cash activities? The first kind of cash activity we come across is relating to financing activity, operating activity, and investment activity. There are three: financing, operating, and investment. So what is financing activity? So you have made some investments in the company. You have given, you have purchased some assets in the company. And what is that? What is that cost which is incurred? And what is the different other kinds of returns you are getting? So when you speak about operating expenditure, you come across the expenses which is incurred in day-to-day activities of the company. So that is under the operating activities. And investment activities, you have invested in the shares or debentures of any other company and you received interest or debenture. So here cash flow statement it also speaks about what is the different changes in the values of your investments. Along with that, what kind of I can also say that how are you going to manage your long-term cash, or how are you going to manage your short-term cash? So managing the long-term cash or the short-term cash is also going to be considered here. But here, this statement only speaks about the recording of the financial transactions, the operating expenditure transactions, or the investments which are being made, these transactions. So that is only being spoken over here. Next is IAS 8. It speaks about accounting policies, changes in accounting estimates, and errors. What is IAS 8? So when I say it, there are different methods of recording the transactions in your business. Let me take it like method of recording depreciation. Which method are you following? Or you have different methods of stock taking, that is LIFO, FIFO, different methods we have. And you have different methods of recording the books also. We have cash method, you have accrual method, cash method or accrual method. So which method are you using? So again, that is going to be, so whenever there is a change in the financial policy, you will also have a change in the financial transaction. Now when I shift my depreciation method from WDV to straight line method, or from straight line method to revaluation method, or from revaluation method to any other method for that matter, there is going to be a change in the depreciation which I have given. So whenever we change a method of depreciation, we need to, suppose life of the asset is 10 years, you have charged depreciation for 5 years. So you cannot, from the 6th year, you cannot charge depreciation under a different method. So what you have to do is, you will have to charge a depreciation for the past 5 years in the new method which you are going to adopt, and any differences which you get there for recording of any differences in that depreciation, that is to be treated in the books of accounts. So that's being told over here. So now when I say it like there are any changes in the accounting policies should be disclosed in the financial statements. Now, so you cannot blankly give a different, suppose in the balance sheet also should disclose what is the method of depreciation you are following, and your cost statement or stock statement should disclose what is the method of stock taking you are considering. And see, this is what the minimum thing which is required. So that is which is being spoken by the IAS 8. And next is IAS 10. It speaks about events after the reporting period. Events after the reporting period. What is this events after the reporting period? There might be some transactions which are incomplete as on 31st March of any year, because 31st March is the last day of closing the books of accounts. There is some transactions which are incomplete. So the same transaction is being completed on 5th of April. Now how are you going to treat such a kind of transaction? You have to refer to this standard. So that is called as events after the reporting period. Now I'll give a small example. When you purchase an insurance is purchased generally for 1 year. So that 1 year insurance which you have purchased it, that you are not going to buy it from 1st April to 31st March only. It can be between December 1st, or it can be on January 1st, or it can be any date in between that year. So now there are certain things which can be advancedly paid, or there has been certain expenditures which is due. Now when I say I am purchasing some raw material and I pay it at the end of the year. So I purchase the raw material and pay it at the end of the year. I need to wait. So what is the date I am going to pay that money? So there are certain transactions which are in between two financial, last year transaction, this year it has happened, or this year transaction, next year it has happened. So how are you going to treat such kind of transactions? That is being discussed under IAS 10. Next is IAS 11. What is IAS 11? IAS 11 is relating to construction contracts. What is construction? Construction of a building, dam, it can be a bridge, it can be a industry. See, any construction of these activities will not be completed within one financial year. Now, you have made the construction of a building partially, 25% is over. And the person who has given you the contract, he says, until you finish 50% of the construction, I'm not going to give you any money. So what he says here, so you need to wait some more time to complete the remaining 25%. So there you have to wait your time. So now whether the profit you earned for the last year or for this year or for the next year. So the point here is, in case of constructions, you cannot expect the construction to complete within 6 months or 1 year, whatever it is. It takes a lot of time. Now, how are you going to treat that, which year profit it is? Because you need to pay tax to the government. Last year profit, you cannot pay tax in the next 2 years. You cannot say that I'm going to pay it after 2 years, because the construction is not yet completed. So here, that is a point which we are going to consider. So now what it says here is, under construction contracts, when are we going to pay the taxes? When are we going to make a record of the accounting? Next is IAS 12. That is, comes under income taxes. Income taxes are paid. It is to be paid at the end of every year. How are you going to treat with these accounting standard is based on the, you are going to consider the taxes which you are going to pay it in the future, or the taxes which are already paid, advance tax which are paid, or you have a deferral tax, you are going to pay it in the next coming years. So that kind of transactions are being discussed under IAS 12. Next, IAS 16, which is relating to property, plant and equipment. What is property, plant and equipment? Properties means it can be anything like purchase of assets, it can be building, it can be a land, It can be any kind of asset. Plant is that which is used for conversion of raw material into finished goods. It can be a factory layout. Equipment are nothing but the machineries, trucks which you use, or heavy equipments which are used for digging, which are used for excavation. So these are all to be considered. So these are all the assets. So all these assets, purchase of the asset, sale of the asset, how to treat the profit on such asset, sale of such asset, how to treat the loss on the sale of such asset, and how to treat the depreciation on such assets. So these are all being discussed under IAS 16. Next is IAS 17. IAS 17 speaks about lease. What is a lease? Lease is that kind of activity where you come across with the payment of some financial amount for using someone else's asset. Now we generally use the term lease. In case of housing lease, what we say, we give 3 years of money, 3 years. Suppose I say that I am going to pay 20,000, you give this property for 3 years I'll use, and then you return me 20,000. Suppose we say house leases. You give 3 lakh rupees, you get a house for lease, you stay in the house for 2 years, and then what you do is, you are going to return the house to them, and they are going to return back the money. So that is not the lease under financial terms. That is a different. Now, under financial terms, lease means, or under this subject, lease means it is only rent. The rent can be an annual rent, or a 3 months rent, or a monthly rent. That is termed as lease. Now, that can also be a lump sum lease also. I say I'll give you 25,000 rupees, you give this asset for 5 years. So 5 years, how am I going to treat that? Now I am using this asset. I need to depreciate a part of that money and say that this is the lease. We generally come across with assets in the balance sheets calling it as freehold asset or leasehold assets. What is freehold asset which is not a leasehold asset or which is free from all kinds of liabilities? What is leasehold asset which has been taken by a authority for only using that asset? We are going to use that asset only. I'll give a small example where in terms of like we have industrial estates. In Tamka we have industrial estates. The government has given that industrial estate only to use. You are not the owner of that. After a certain number of years, you need to return back that asset to the government. So this is the term lease. Now, when you pay a lump sum amount, we come across lump sum amount being paid. The lump sum amount which is being paid, it is nothing but we treat it as a lump sum payment, and every year during the term of the lease, we go on deducting certain amount and put it to the depreciation. Suppose we are paying lease monthly basis, we treat it as rent, and that we are going to transfer it to the profit and loss account. Next, IAS 18, revenue. What is revenue? So revenues are nothing but incomes which the company has earned. How do you treat a revenue? As a capital revenue or a revenue expenditure or a capital expenditure, revenue income or a revenue income or revenue expenses. So they say that how are you going to, there are certain expenses which are being treated as revenue, certain expenses which are being treated as capital. Certain expenses which are treated as capital expenditure and certain expenses treated as revenue expenditure. So that is being divided. IAS 19, employee benefits. What is employee benefits? Now you are an employee of a company and the company has an agreement to pay you a certain amount of money after the tenure. Once the tenure is over, the company will be ready to pay you a certain amount of money. Take it like 25 years you worked for the company and you are leaving the company and going out. Now the company has to give you a gratuity, it has to give you pension. Now how are you going to record all this? Because gratuity, company is not going to bear it from its own hand. Out of the salary which you have given to which the company has given to the employee, certain amount of money is being transferred as SIF. And that money goes on multiplying. So when it goes on increasing, that money will be transferred to the employee at the end of the retirement. So now, how are you going to treat this kind of expenditures? That's been discussed here. Accounting for government grants. What is a government grant? Generally, to motivate or to promote certain activities, the government will provide grants. Government is going to provide grants. These grants which the government is going to provide, it can be of many types. Government can give you subsidy in the interest rate of the loan. Government Government also can give you subsidy in the machinery. Government can give you free supply of machinery or free supply of raw material, or government can give you subsidized rate of interest on the loan which you borrow. Government can also give you subsidy after you finish a certain number of years of your business. So how are all these being treated? Government can give you one-time lump sum advantage, government grant, or it can also give you one-time short-term grant. So there are various things which we have to consider here. Next, IAS 21. IAS 21. It speaks about the changes in the foreign exchange rates. Now, what is this foreign exchange rates? You have ordered an asset for $1 lakh. On this date, the exchange rate was 60 rupees. By the time you could receive that money, receive that goods and make the payment, the dollar rate is 70 rupees. How do you treat the difference in this? That's been discussed here. Either the profit on the sale of the asset or on the loss on the sale of the asset, or any changes in the financial rates or the transactions. Changes in the financial rates or the transactions. How are we going to treat this? That is being discussed under IAS 21. Next, IAS 23 is relating to borrowing cost. It is nothing but the interest which we have to pay on the money which is being borrowed. That is being discussed under IAS 23. IAS 24. Related party disclosures. What is related party? A subsidiary or a joint venture or a holding company, whatever it is. When your company has a control on a third party, and you need to record those companies' financial statements also in your books of accounts, there we come across with the related party disclosures. IAS 26. It speaks about reporting by retirement benefit plans. I have already told you retirement benefits to the employees, that is being discussed. 27. Separate financial statements. Now you come across joint financial statements, joint two companies. When you are holding under a subsidiary company, you need to prepare, the holding company should prepare its balance sheets with the subsidiary company also. So that's been told here. So there we come across separate financial statements. Next is investments in joint ventures. What is joint venture? The same thing as I told you. Joint venture is a risky businesses which you have made some investment in such companies. Joint venture is transaction. How it makes is, you make a 10 lakh rupees of investment in a business and you say, you give this to me along with a profit, and finally after 10 years you are going to return all this money to me. So that's what joint venture does. Financial reporting in hyperinflation economies. What is hyperinflation? Gold rates, past 1 year it has increased by 2000 rupees. Increased by 2000 rupees. Now gold rates in the past 1 year increased by 2000 rupees is really a great activity through inflation. Now how are we going to record the balance sheets of such assets? There might be an expenditure. I purchased an asset only for 10,000. Today it is around 50,000 rupees, only 1 year. So recording that is also, because your balance sheet should disclose the fair value of assets and liabilities. You cannot write only 10,000. IAS 13, financial instruments presentation. How are we going to present the financial instruments? How are you going to present the financial instruments? So that's been considered. Like financial assets, how we are going to record, preference shares, how we are going to record, and other financial instruments which we come across. Take it like debentures, take it like derivatives, any other financial instrument. How are we going to record that? And profit or the sale on such assets, how are you going to, how it is going to happen? So that we are going to consider. IAS 33 is relating to EPS, earnings per share, diluted EPS and basic EPS. EPS is that factor which has a great impact on the market share of the companies. The market share values of the companies increase based on the EPS. If the EPS is less, the market shares also do expected to fall down. So diluted EPS we'll have to consider based on the financial income which the company has received. IAS 34. It speaks about the interim financial reporting, which is reporting of the financial statements between two financial dates. Between two financial dates. What is the two financial dates? I can say that companies which have got a turnover of more than few thousand crores, they need to report every 3 months because the government wants to collect advance income tax from them. So they go for interim financial reporting. IAS 36, impairment of an asset. What is impairment? Is the opposite word for impairment. Impairment means joining together. Impairment means removing the join. Now when there are 10 assets working for one activity, one process of production, 10 machineries are there. Suppose some machinery you are not able to work on, you are removing that. So that is impairment. You are removing that, bringing a new asset and placing that in between the assets. So that is impairment of assets. IAS 37, contingent liabilities and contingent assets. Contingent liabilities are those which can be a liability if you don't accept it. Contingent assets are those which can be your asset shortly. So contingent assets and contingent liabilities, how to treat them and how you are to record them in the balance sheets and what is the procedure for treating them is being explained under IAS 37. Intangible assets. Intangible assets, as we all know, it can be a software, it can be a trademark, it can be a patent, it can be movie, it can be music, it can be songs, etc., etc., etc. So intangible assets are many in nature. So how are we going to record all them? So suppose a formula for coronavirus medicine. So that is also an intangible asset and it is being patented. Suppose a medicine starts curing the coronavirus, then it is going to be patented. So you have made some expenditure to do that research, 100 crores, 500 crores like that. So that money which you are going to use it for the research is also to be the fixed asset, and the profit what you get on such asset, or you are selling that asset, how you are going to get that profit, all these are being discussed. IAS 39, financial instruments recognition and measurement. This already explained under IFRS 9. And IAS 40, which I already studied under IFRS subject 5th semester BCom, that is investment property. This investment property is which those assets which have purchased these assets only for increase in their, only for earning some revenue. You are purchasing this asset, giving it to rent for someone, and you are earning returns from that. Such kind of assets are treated under investment. IAS 41, agriculture, relating to agriculture. So what is this relating to agriculture? You have certain plants, you have certain land, you have crops, all these do come under agriculture. So it can, we also have medicinal plants, anything like that. They all come under agriculture. And how to, because we have many companies which are dealing with it now. So that's all been discussed under IAS 41. So this is about the different financial accounting standards. The next concepts we will discuss in the next class. Thank you. All of you see this video and you can ask me any doubts if you have.